Welcome back to the deep dive. Today, we're diving into Dhandho.
Dhandho.
Yeah, Dhandho. It's this Indian concept all about making smart bets in business investing, where the potential rewards, they're high, but the risks, super low.
Like stacking the odds in your favor.
Exactly. And we're going to explore Dhandho through some real-life stories, incredible ones, actually, from this book, The Dhandho Investor by Mohnish Pabrai.
You know what's interesting about this book? The dedication. It's to Pabrai's college roommate, Ajay Desai. He's the one who first introduced him to Dhandho.
Oh, wow. So, like, the power of shared knowledge.
Exactly. You never know where a single conversation might lead you.
That's what we're hoping for today, a spark, for you. We'll uncover how Dhandho helps some immigrants totally dominate a whole industry here in the U.S.
And the thing is, Dhandho, it's not just for business. It can apply to any decision, really.
Okay, so first story. Ready? The Patel Motel Empire. Picture this. Early 1970s, a small group of Gujarati Patels. They arrive in the U.S. I mean, talk about challenges. Language barriers, limited capital, the culture shock. It's a lot.
That's where Dhandho comes in.
Mhm.
They didn't try anything fancy. No reinventing the wheel. Just focused on motels. Simple, existing, manageable.
So, like, safe, right? Instead of some big risky thing, they went with what they sort of knew. Seems smart.
It is. Motels, they're straightforward to run, don't need a ton of cash up front.
Makes sense. So anyone listening, think, what are those kind of overlooked businesses in your field? The ones with hidden potential, maybe?
And the Patels. They were amazing at spotting value where everyone else just saw risk. They went for those distressed motels, the ones in less desirable locations. Got them cheap.
Bargain hunting, but on a business level.
Exactly. And then, clean, basic rooms, cheaper than the big chains, found their niche.
Not trying to be the Hilton, they made their own game.
Right, and they worked hard. Family run, often, keeping costs down. That personal touch mattered.
It's like that lean startup idea, but way before it was cool.
It's timeless. And it worked. Within a few decades, over half the motels in the U.S. were theirs. Multi-billion-dollar empire.
From those humble beginnings, it's kind of inspiring, isn't it? Shows you what focus and smart choices can do.
And a big part of it, that margin of safety idea, never overpaying, always leaving room for error, core Dhandho.
Like protecting yourself on the downside, so even if things go wrong.
You don't lose big. It's a principle for anything. Stocks, starting a business, even like buying a used car.
Okay, next story. Manolo Chuduri. Came to the U.S., family in tow, more challenges like the Patels, but driven, determined.
Patience and discipline, that's Manilo. Multiple jobs, lived frugally, saved every penny.
No, get rich quick, just steady building.
And he was smart. Learn the motel business inside and out, work those jobs to gain experience.
Paid to learn, basically.
Exactly. Knowledge as an asset. Then he waited for the right moment.
And that moment, it's kind of chilling. After 9/11, travel industry tanked. Motels, prices plummet. Everyone's scared.
And he saw his chance. Fear in the market. That's a buying opportunity for a Dhandho thinker.
Crisis equals opportunity. So many lessons there for everyone, right? Like, how do you turn a bad situation into a good one?
He got that motel dirt cheap. Savings, knowledge, it all came together.
The dollar for 50 cents thing again?
And his family. They were in on it. Working, saving, a team effort.
So it's not just individual hustle, it's the support system too, huh?
Dhandho. It's a family affair sometimes. A reminder that success is often a shared journey.
But here's the key takeaway. Dhandho isn't just about motels. Small startups, giant companies, Richard Branson, Lakshmi Mittal, they all used it.
Branson, the Virgin Group guy. He built an empire from practically nothing, always looking for those low-risk, high-reward plays.
The master of creative deals. Like, remember Virgin Atlantic? He started that airline with a one-year lease on a USC Boeing 747.
Bold, but calculated. Low investment. If it flopped, he just gives the plane back.
Heads, I win big. Tails, I lose small. That's Dhandho in a nutshell. And it worked. Global empire now. Airlines, music, space travel. Wild.
So what's the takeaway? Be resourceful, think outside the box, don't be afraid to negotiate those creative deals.
You don't need millions to start.
Nope. Just leverage, minimize risk, and build gradually.
And then there's Lakshmi Mittal. Steel tycoon. Another Dhandho principle. Finding value in those distressed assets. Bought struggling steel mills cheap and made them efficient, profitable.
He saw potential where everyone else saw a headache. Knew a down market meant bargains galore.
Buy low, sell high. But he wasn't just sitting around. He made those businesses better. Leaner, more valuable.
Sharp eye for value, plus he knew how to run things. Powerful combo.
So many ways Dhandho works, right? Different businesses, industries, scales. But what are the principles specifically? I mean, the book lays out 9, like a roadmap to better decisions.
A roadmap, yeah. Whether you're an entrepreneur, investor, or just, someone trying to make good choices in life.
Okay, so first principle, hit me.
Buy existing businesses. Don't start from scratch. Right away, less risk. Because you're not dealing with all those unknowns of building something new.
Like you're buying a house that's already there,
Yeah.
move-in ready, versus designing and building the whole thing.
Exactly. Skip the headaches, get right to running and growing the business. Less pioneer, more opportunist.
Makes sense, less risk. Okay, what's next on our Dhandho map?
Keep it simple. Understandable businesses, you should be able to grasp it. If it's too complex, too many moving parts, that's where hidden risks hide.
So stick to what you know, right? If you can't explain how a business makes money to a 10-year-old, maybe it's not for you.
Exactly. And this leads to number 3, which might sound odd. Look for distressed businesses in distressed industries. That's where the real deals are.
Wait, so look for trouble. Isn't that risky?
Not if you do the Dhandho way. Remember, minimizing risk, maximizing returns. When an industry is struggling, that's when things get undervalued, like those Patel motels back in the day.
Everyone else is running away, but the Dhandho person sees opportunity. I like it. But how do you know it's not just a bad business about to go under?
Principle 4, durable moats. A moat, it's that competitive edge that protects profits. Strong brand, loyal customers, unique product, or just being super efficient. Hard for rivals to compete.
So, a company with defenses, built to last.
Think Apple, Google. Huge brands, customer love, innovative products. Tough to beat that. Deep moats.
Okay, so you find the business, but you gotta invest right. Pabrai talks about a few big bets, infrequently.
Right, not spreading yourself thin. Concentrate resources on those rare, high-GH conviction opportunities, like Manila waiting for that motel deal.
Patience is key, why? Not chasing every little thing, it's that one perfect pitch you hit out of the park.
It's methodical, strategic, not emotional, not rushed.
Earlier, the Patels, arbitrage, finding those market gaps, feels like a core part of Dhandho.
Yes. 6th principle, exploit arbitrage, wherever you can profit from those market inefficiencies.
Example, besides motels, so folks can imagine.
Okay, real estate. Say there's this neighborhood. Property's way undervalued compared to the next one over. Only difference is perception. Maybe. One's trendier, but the houses themselves are similar.
Information gap, kinda. Market's not pricing it right.
Bingo. Buy low there, spruce them up a bit, sell high in the fancy neighborhood, bridging the gap, profiting from it.
Gotta be observant. Know your market inside out to spot that stuff.
It's everywhere if you look. And it's not just business, it's your career, your personal finances, even little daily choices. Being resourceful.
Love it. Okay, what's the next Dhandho principle to check off our list?
Margin of safety.
Yeah.
Huge in value investing. It's all about minimizing that downside. Never pay full price. Leave room for error.
Built-in cushion, a buffer, so if things go a little sideways.
You're protected. Buying a used car, research seems good, but what if there's a hidden engine problem or the transmission's wonky?
You don't offer top dollar, right? Negotiate down a bit, just in case.
Margin of safety. Same with stocks, businesses. Buy below what you think it's worth.
Buying that dollar for 50 cents again.
That's the Dhandho way.
Okay, this one's a little confusing to me. Low risk, high uncertainty businesses. How can it be both?
Risk versus uncertainty. Risk we can measure, like odds of flipping heads. Uncertainty, that's the unknowns, the stuff you can't predict.
Like knowing your poker hand odds versus predicting who will win an election, or, I don't know, what the internet will be like in 10 years.
Exactly. Find businesses where even if the future is hazy, your downside is small. Often, that's where the big wins are.
Example, to make it concrete.
Early internet days.
Yeah.
Total uncertainty. But those who invested despite that, massive payoffs.
Betting on the right horse when nobody knows WHO is going to win. Risky, but huge reward.
Now for the final Dhandho principle. This might raise some eyebrows. Better to be a copycat than an innovator.
What? Steal ideas?
No, recognize what works. Adapt it. Innovation's risky, expensive, no guarantees. Imitation, much safer path. Learn from other people's mistakes, make their ideas even better.
Microsoft's the classic example, right? They didn't invent operating systems or word processors.
But they perfected and scaled them. Big lesson there. You don't always got to be first. Sometimes the smartest move is to be second or third, but better.
So be strategic, opportunistic. Not just running out front, but making the right moves. Okay, those 9 principles, they're all about those smart bets. But the book, it goes deeper than just money, right?
It does. Dhandho, it's about using your wealth ethically. It's about fulfillment, making a positive impact on the world.
Aligning your success with your values, basically.
Pabrai, he talks about philanthropy, giving back. True wealth isn't piles of stuff. It's about making a difference.
Success, but like the whole picture, not just the bank account.
It's a meaningful life, that balance between financial well-being and being a good human.
Money's a tool, not the end goal, just how you get there.
Use it wisely,
Right.
responsibly.
We talked about arbitrage, the Patels and all, but to really get it, can we dig deeper into that concept?
Sure, it's those market gaps, right, where you can profit.
Yeah.
And those gaps, they're sneaky.
The book mentions this barber. Small town, miles from any competition. Simple business, but deep idea there.
He was the only game in town. Charge more profit, arbitrage by finding a need and filling it.
Built-in advantage. Mini monopoly until someone else shows up. Classic Dhandho. But how's this work with stocks? That's a whole different beast.
It is, but the principle's the same. Sometimes a stock's price doesn't reflect reality. Maybe fear, bad news, or people just don't get the company.
So it's like that small-town barber. Undervalued because nobody else is around to do it better.
The Dhandho investor spots those hidden gems. Stocks trading below their actual worth. Patience, research, then bam, buy when the market's asleep at the wheel.
Be a savvy shopper no matter what you're buying.
Value conscious. Get that bang for your buck.
Durable moats, those defenses. If we're trying to spot them, what are the clues?
Few things. Brand recognition. Coke, Disney, that level. Their brand alone is worth money. People pay more because they trust it.
Shorthand for quality. You know what you're getting.
Hard to compete with that. Another one. Unique product service. Something nobody else has.
Secret tech, recipe, a way of solving a problem that's one of a kind.
Competitors hate that.
The book uses this cool analogy for selling Chakravyu, battle formation, right? Can you unpack that one?
Chakrava is from the Mahabharata, ancient Indian epic. Super complex spiral formation. Like a maze, only one way in and out. Almost impossible to break.
Intimidating. So how's that relate to stocks?
Metaphor for investing. You buy a stock, you're entering the Chakravyu. Need a clear entry strategy, why you're buying, and an exit strategy, when to sell. A plan for the market's maze.
Not just hoping for the best, huh?
Nope. Be strategic, know your goals, how much risk you can handle.
And from that story, patience is key. You can't rush in, Andy out. Got to be ready to hold, even for years.
Stick to the plan,
Yeah.
even when the market's going crazy.
Don't panic and sell just because things dip a little. Long-term view, ride out the storm.
The goal is to get OUT of that Chakravyu with your profits.
We talked low-risk, high-uncertainty businesses. The book uses steward enterprises, funeral homes. Bit of a morbid example, but tell us about it.
Right, so early 2000s, Stewart Enterprises, in trouble, debt, stock price down. Lots of folks thought too risky.
Yeah.
But Pabrai, he saw a solid business with a unique moat.
Which is?
Death. It's going to happen. People always need funeral services.
A moat you can't really argue with. Dark, but effective.
Dhandho mindset, right? That fear around the company, that's the opportunity. Low risk, because the need is always there. High uncertainty, because they were in a rough spot.
Betting on, well, death.
Betting on a mispriced company. Strong moat, and they had options to deal with their debt. Pabrai figured bankruptcy, odds were low.
So even with the unknown future, he saw a way to make money.
And he did. Stewart Enterprises bounced back. He profited nicely. Classic example. Look past the headlines. Understand the real business, especially when things are uncertain.
Sometimes you gotta go where others are scared to go.
That's Dhandho.
Being a copycat, not an innovator. Microsoft, we get it. But for the everyday person, not building tech giants, how's that work?
It's a mindset. Any field, you don't have to be original. Learn from what's already working. The successes, the failures, adapt it all to you.
Be a student of success, like we were saying.
Find those people, businesses, crushing it. How do they do it? Habits, decisions, what makes them different? And then experiment, adapt it. What works for them might not work for you exactly.
Masterclass from the best, then make your own masterpiece.
Don't just blindly copy. Get the core principles, the WHY of their success. Make it your own.
Even Warren Buffett, right, the goat of investing, he's not above borrowing good ideas.
Pabrai himself, he's a Buffett cloner, basically. Open about it. Adapted those ideas to his style.
And it's working for him. Dhandho, it's more than a list of rules, it's how you think. So practically speaking, how do people actually do this copycat thing.
First, you got to find your role models, right? The people, businesses doing what you want to do and doing it well.
Got it. Study the greats. But then what?
Break it down. Their habits, how they decide things, what makes them stand out.
So observe, analyze, become a student of their success.
And don't just observe, try stuff out. Adapt. What works for one person might not work for another. Their playbook, but your style.
Taking the master class, then making your own W inversion. I like it.
It's not about being a carbon copy. It's about grabbing those core principles, the strategies that made them win. Then you make them yours.
Wow, we've covered a lot today. This whole world of Dhandho, the principles, the stories, how it all applies to, well, everything, not just business, but life choices in general.
And it's not some new fad, These Dhandho ideas, centuries old, been working for entrepreneurs and investors forever, as relevant today as they were way back when.
Simple ideas, but powerful. As we wrap up our Dhandho deep dive, what's the one big thing you want listeners to walk away with?
Calculated risks. That's it. Dhandho isn't about playing it safe all the time. It's about knowing the risks, minimizing them, then going for it when you've got the odds on your side.
Big dreams, but with a backup plan, right?
Yeah, ambition and caution. I really believe anyone can use this. Dhandho, it levels the playing field. Doesn't matter where you come from, what you've done before.
Giving you the power to choose better, reach your goals, and do it all while feeling financially secure.
So as you go through your day, your week, remember what we talked about, those arbitrage moments, the companies with moats, learn from the copycats, not just the pioneers, and most importantly, be patient, be strategic, and when the time's right, be bold.
Awesome. Thanks for joining us for this deep dive into Dhandho. We hope you found it valuable, got you thinking. If you have any questions or thoughts about Dhandho, we'd love to hear from you. Share them on social media with the hashtag #HandoDeepDive. And of course, pick up a copy of The Dhandho Investor to really go deep on this stuff. Until next time, happy Dhandhoing.